Imagine buying a business where most customers hardly ever come back after the first day, yet the payments keep arriving every month. That is the promise people see in self-storage. A customer rents a small locked room, moves in furniture, business inventory, or boxes from a recent move, and then leaves. The operator does not have to clean the unit every morning or replace perishable inventory. Compared with an apartment building or a hotel, the daily routine can be lighter. That does not make the property passive. It still needs marketing, maintenance, security, collections, customer service, and someone to deal with the things that go wrong. Even so, once enough units are rented, the business can look unusually simple from the outside. That simplicity attracts investors. The income is recurring, the product is easy to understand, and one facility may serve the same neighborhood for decades. But a simple business is not automatically a simple investment. A storage facility can be full and still disappoint its owner. The reason may have nothing to do with the customers. The buyer may have paid too much, borrowed too aggressively, or assumed that current rents would keep rising without resistance. So the useful question is not whether self-storage makes money. Plenty of facilities do. The useful question is narrower. After operating costs, financing, and the purchase price are taken into account, does this particular property leave enough cash to justify the risk? That answer begins with a row of metal doors, but it is not found there. Consider a hypothetical 500-unit facility. Across all unit sizes, suppose the posted average rent is $150 a month. If every unit stayed occupied for the entire year, the rent roll would show $900,000 of potential revenue. That is only the starting point. A facility may report 90% physical occupancy, meaning roughly 450 units are rented, while the cash collected tells a less flattering story. Some tenants may still be on older, below-market rates. New customers may have received a discounted first month. A few accounts may be delinquent. The headline occupancy number does not reveal any of that. Assume the property collects $810,000 in rent over the year and earns another $40,000 from tenant protection plans and other small charges. Total revenue comes to $850,000. These are hypothetical numbers for a mid-sized independent facility, not an industry average. Now the bills arrive. Property taxes, insurance, repairs, utilities, advertising, on-site labor, software, and management all have to be paid. After $330,000 of property-level operating expenses, the facility produces $520,000 in net operating income, or NOI. NOI is not the owner's final profit. It does not subtract mortgage payments, depreciation, income taxes, or major capital projects. It measures what the property itself earns from operations before financing. That distinction matters because a seller may point to $850,000 in revenue, while a buyer is really purchasing the $520,000 that remains after the property is run. Even that number deserves a closer look. A roof replacement may have been delayed. Insurance may be about to reset at a higher price. A recent increase in occupancy may have been purchased with heavy discounts. The clean doors are easy to photograph. The quality of the income takes longer to understand. The part of self-storage that makes the business unusually attractive is not the building. It is the effort required to leave. Take a hypothetical customer named Sarah. She rents a unit while moving between apartments. The plan is temporary. An old sofa goes inside, followed by several boxes she does not have time to sort. Once the move is over, she tells herself, she will come back and deal with everything. 6 months pass. Sarah is settled in her new home, and the storage unit is no longer solving an urgent problem. Still, canceling is not as easy as pressing a button. She would have to rent a truck, open every box, decide what to keep, and spend a Saturday doing work she has already postponed several times. The monthly charge bothers her, but not enough to create a free weekend. From the operator's perspective, Sarah can be a valuable customer. She visits rarely, asks for little service, and stays longer than she originally expected. This also affects pricing. Before moving in, she compares nearby facilities carefully. After her belongings are behind the door, a modest rent increase feels different. Leaving now carries a real cost in time and effort. Most self-storage leases are month to month, but owners still have to follow the notice requirements in the lease and the law that applies in that state. After the required notice period, an operator may be able to raise the existing tenant's rate. The increase cannot be pushed forever. A large jump can finally persuade Sarah to empty the unit, especially when a competitor offers a cheap move-in deal. The business works because enough customers stay longer than planned, not because every customer stays forever. Sarah explains the recurring revenue. She does not explain whether the property is worth buying. Now imagine that same facility is offered for sale with 90% physical occupancy. A first-time buyer may feel relieved. The property already has tenants. The seller can show years of collections, and there is no need to build from scratch while hoping demand appears. A more experienced buyer spends less time admiring the occupancy figure and more time tracing where it came from. The rent roll shows that many long-term tenants are paying well below the rates advertised by nearby facilities. That could create upside, but it may also be the reason they have stayed. If the new owner raises those rents after the required notice period, some tenants will accept the increase. Others may finally decide that the boxes behind the door are not worth another year of payments. Then a local planning document reveals that a climate-controlled facility has already been approved a few miles away. It has not opened, so today's occupancy says nothing about the effect it may have next year. The buyer is no longer looking at one simple number. The property is full partly because the old owner kept rents low, and the chance to correct those rents may arrive at the same time as new competition. A national operator may recognize this pattern faster because it has seen similar facilities before. That history is useful, but it is not magic. The company still has to decide how much of the current income is durable and how much depends on conditions that may be changing. The 90% figure remains accurate, but it does not contain the whole story. One buyer may pay as though the existing income is protected. Another may offer less because the property needs room to absorb tenant departures and slower rent growth. They are not disagreeing about the building. They are paying for different versions of what happens next. Self-storage is often discussed as a national industry, but each facility lives in a local market. A customer storing a sofa or business equipment usually wants a place close enough to reach without turning the trip into a project. That makes nearby housing, traffic patterns, access, and competing facilities more important than a broad national growth chart. Picture a buyer studying a property on the edge of a growing suburb. New homes are appearing, and the seller points to the population increase as proof that demand will keep rising. The story sounds convincing until the buyer checks what else has been approved. 2 other storage projects are planned along the same road. Neither is open yet, so the existing facility remains nearly full. A year after the purchase, hundreds of new units may be competing for the same households. The market can absorb some of that supply if the area keeps growing. The problem is timing. The buyer's mortgage begins immediately, while the expected population may take years to arrive. Development creates another trap. A builder may look at strong rents and assume a new facility will succeed at the same prices. By the time construction is finished, competitors may have started discounting, and the lease-up period may take much longer than the original model assumed. An existing facility avoids part of that risk because it already has customers. It does not avoid the local market. Citywide statistics can also mislead. A metropolitan area may appear undersupplied while one neighborhood already has several facilities competing within a short drive. The reverse can happen as well. A city may look crowded overall, yet a fast-growing pocket has very little convenient storage. The buyer is not purchasing the average market. The buyer is purchasing one address and the customer habits around it. National demand can make the industry attractive. Local supply decides whether a particular address earns the return shown in the spreadsheet. Once the buyer is comfortable with the NOI, the conversation turns to price. Commercial real estate is often valued with a capitalization rate, usually called the cap rate. The calculation is straightforward: current annual NOI divided by the purchase price. If the facility produces $520,000 in NOI and sells for about $8.7 million, the going-in cap rate is roughly 6%. At a purchase price of $10.4 million, the same NOI creates a 5% going-in cap rate. If buyers require 7%, the implied value falls to about $7.4 million. The building did not change between those examples. The amount investors were willing to pay for the current income changed. A cap rate is useful, but it is not a promised return. It does not include the buyer's debt, future capital spending, rent growth, or the price received when the property is eventually sold. It is simply the unlevered yield implied by today's NOI and today's purchase price. That limitation is important because a low cap rate often comes with an optimistic story. The buyer may believe rents can be raised, occupancy can improve, or expenses can be reduced. Sometimes the story is correct. The danger appears when the price already assumes most of the improvement. If the buyer pays $10.4 million for a property producing $520,000 in NOI, even a modest decline in income can remove a meaningful share of the initial yield. The facility may still look healthy, most units may remain rented, and customers may continue paying on time. The buyer has still paid a high price for a relatively narrow stream of current income. A cap rate cannot tell the investor whether the future will be good. It shows how much confidence has already been built into the price. Debt can make the same property feel like two different investments. Return to the $8.7 million facility with $520,000 in NOI. For illustration, assume the first buyer contributes 50% of the purchase price and finances the rest with a fixed-rate loan. Suppose the annual debt service is about $270,000. Before income taxes and major capital projects, the property leaves roughly $250,000 in cash flow. If NOI falls by $60,000 during a weak year, the owner still has room to pay the mortgage and keep the property running. Now consider a second buyer who pays $10.4 million and finances 70% of the price at a higher interest rate. Assume the annual debt service reaches about $470,000. The facility still produces $520,000 in NOI, but only $50,000 remains after the loan payment. On paper, the second buyer has used less of their own cash relative to the size of the deal, which can make the projected return look attractive. In practice, the margin for error is thin. A jump in insurance costs, a major repair, or a few weak months can erase the cash flow. The property may continue serving customers and collecting rent while the owner has to contribute additional money. Nothing about the building changed. The financing changed what the owner could survive. Leverage is useful when income is stable and the loan is manageable. It becomes dangerous when the deal requires the property to perform almost exactly as forecast. Customers do not care what interest rate the owner accepted. They will not pay more simply because the mortgage is expensive. A conservative loan cannot rescue a bad property, but it can give a sound one enough time to recover from an ordinary setback. A hypothetical investor named Daniel bought a storage facility 10 years ago for $5.2 million. The property produced less income at the time, but the lower purchase price and a manageable fixed-rate loan gave him breathing room. He did not need to push rents sharply after closing. Gradual growth was enough to cover the debt, pay for repairs, and leave cash for the owner. Years later, the facility was producing about $520,000 in NOI. Demand in the area had improved, and investors were willing to pay more for self-storage. Daniel received an offer of $8.4 million and sold. The new buyer did not purchase a bad business. The units were mostly occupied, collections were consistent, and the property had a long operating record. The difficulty appeared after the loan payment. Because the new owner had paid much more and financed the acquisition at a higher rate, the annual cash flow was small. The business only had to perform slightly below the forecast for that cash to disappear. Insurance renewed at a higher price. Several doors and sections of roofing needed work. A nearby competitor opened with discounted move-in rates. None of those events was dramatic enough to destroy the property, but together they absorbed the owner's cushion. Daniel had owned a facility that could tolerate an ordinary setback. The new buyer owned one that needed most assumptions to go right. That does not prove Daniel was a better operator. He benefited from the price and financing available when he entered. The seller could honestly say that the facility was a good business. The buyer still had to decide whether it remained a good investment at the new price. The property had changed very little. The economics of owning it had changed a great deal. Not every investor who likes the business wants to own a facility directly. Imagine a hypothetical investor named Maya. She is interested in the recurring income from self-storage. But she does not want to negotiate a property purchase, arrange a commercial loan, or concentrate most of her capital in one local market. A self-storage REIT gives her another route. Instead of buying one building, Maya buys shares in a company that owns facilities across many locations. The company handles pricing, maintenance, acquisitions, and financing. She can enter with far less money and sell the shares through a brokerage account. That convenience changes the risks rather than removing them. Maya does not control what management pays for the next acquisition or how much debt the company uses. The share price can fall when interest rate expectations change, even if customers continue renting units. It can also rise faster than the underlying business when investors become enthusiastic about the sector. Direct ownership offers more control. The owner chooses the financing and decides when to sell. In return, a roof problem, a tax increase, or one aggressive competitor can affect the entire investment because there is no national portfolio to absorb the shock. The two routes serve different investors. Someone with local knowledge, operating skill, and enough capital may prefer direct ownership. Someone who values liquidity and diversification may find the REIT structure more practical. The question is not which form is always better. It is whether the investor understands what they are giving up to obtain the benefits they want. In both cases, price still matters. A great facility can be a poor purchase, and a strong REIT can disappoint when its shares already reflect years of expected growth. A sound self-storage deal usually looks less exciting than the deal presented in a sales brochure. The buyer does not need a dramatic turnaround after closing. Existing income already covers the operating costs and the loan with room left over. The budget assumes that repairs will happen and that some expenses will rise. The local market does not have to remain perfect. Occupancy can weaken for a period without placing the mortgage in danger. If rent increases take longer than expected, the investment still produces an acceptable result. That kind of deal may show a lower projected return than a heavily leveraged acquisition. It also has a better chance of surviving. Self-storage demand often appears during moments of change. People move, households combine, businesses run out of room, and families need temporary space after an unexpected event. Those patterns can make the sector more resilient than some other property types. That resilience has limits. A local market can still be overbuilt. Insurance and property taxes can rise. A facility with weak security or poor access can lose customers even when the wider industry is doing well. A sound investment does not require the owner to predict every outcome correctly. The price and financing leave enough space for ordinary mistakes, delays, and surprises. That idea sounds conservative because it is. Real estate rarely fails because a building suddenly stops existing. More often, the problem begins when the buyer pays for growth that has not arrived and borrows as though nothing will interrupt it. A durable deal can live with an imperfect future. Sarah still explains why the business works. She rented during a move, settled into her new home, and kept paying because clearing the unit always felt like a job for another weekend. Her behavior creates durable revenue. It does not determine value. Value comes from the cash left after the property is run. Compared with the price and financing required to own that cash flow, self-storage becomes a good investment when a durable business is purchased on terms that do not require a perfect future.